My name is Bill Ennis. I am President of the CFA Society Atlanta. On behalf of the Board of Trustees, I'd like to welcome you to today's event, Masters of Private Credit 3.0. Before we get going, I'd like to mention a few upcoming events. On May 7th, we have our sponsor series, a multi-asset panel. That'll be from 5:30 to 8 p.m. Following day on the 8th, we have a webinar series, Financial Modeling Best Practices. That's from 12 to 1. And then last event of the year will be our annual meeting on June 5th, held at the Grand Hyatt. We're very pleased to welcome the Vice Chairman of Goldman Sachs, Rob Kaplan. Check our website, www.cfa.atlanta.org, for all details and to register and see other events that are there. We are thrilled today to be joined by industry-leading experts as they share their current views on what's driving market growth in direct lending, asset-based finance, and sector-specific lending strategies. Today's discussion is monitored by our VP of Programs, Scott Roberts. Without any further ado, let's give him a warm and welcome and take it away, Scott.
Thank you, Bill, for the intro. Is the audio okay in the back? All right, thanks for the intro, and thank you all for being here today with us. This has become somewhat of a hot ticket. Also, thanks to the CFA Society Atlanta for having me back to moderate the Masters of Private Credit 3.0. Early last week, I received an unexpected phone call from a chief investment officer who said, as I looked at my phone, I thought, how did they get my personal cell? And the second thing I thought was, I better take this call. So I answered and I said, how can I help? And the CIO said, we need 2 tickets to the Masters and we're told that you're the person to speak with. And so I thought to myself, well, this is going to cost us 10 grand. And I said, sure. Which day do you want to head out to Augusta? And the CIO said, I thought the Masters of Private Credit was in Buckhead. I said, that's sold out. Sorry, I can't help. That's why finance people don't do stand-up comedy. We couldn't be more thrilled with today's all-star panel, given that the 3 collective firms here manage just over $620 billion of the $2.5 trillion private credit marketplace. We'll talk about the growth for the sector overall in different sectors in just a few moments. But when we think about the changes coming to private credit and the changes that are impacting the public markets, a lot of this will make sense at the end. We'll cover a lot of ground over the next 45 minutes, discussing some of those changes. We'll save 15 minutes for Q&A at the end, so please get your questions ready as we go through the opening remarks. I see a lot of familiar faces in the crowd, and so this may sound familiar coming from me, but the definition of private credit means different things to different investors. Our hope is that you leave today with a better understanding of some of the key opportunities and risk within each unique segment of the asset class. So before we get into the questions, let me briefly introduce our panel. Next to me is Avi Korn from KKR. He's co-head of asset-based finance. In the middle, we have Jeannie Powers from EIG, where she leads the firm's traditional energy lending business, and Michael Smith on the end, who is co-head of the Ares Credit Group. So with that, we'll get into our questions. And the first one may be the toughest of the day. We're going to start on the end with Michael, and that is, in one word, how would you describe the private credit opportunity in 2025?
I've been thinking about this all morning. Busy.
Busy. Okay, Jeannie?
Ready. Oh. Ready? Everyone can hear me. Ready.
So busy, ready, and Avi?
I've been thinking about this also, so I have the most syllables in my word. Unignorable.
Wow.
It is a word. I'm going to put that out there for all of you.
All right, we're going to come back to these for a variety of reasons. As we think about the growth in the asset class, there's a variety of estimates out there, and one of the numbers I threw out was $2.5 trillion. Now, there are estimates on asset base that are as big as $30 trillion over the coming years. Let me start on the end with Michael again. And where do you think we go over the next 3 to 5 years if we're assuming today's base is $2.5 trillion?
Yeah, we struggle with this number too, and say, $1 trillion up to $5 trillion, whatever that market is. It depends how you define it, which again, we'll try to do today. But when we grew up doing the business, it was kind of lender finance, sponsor finance. That's kind of the business that we built. But if you expand that out to include infrastructure debt, asset-backed lending, all that type of stuff, we probably think it's more like a $30 trillion opportunity set, of which we're still 5% of, something like that. So somewhere around that $3 trillion number. And we would say that it's probably going to grow at 10 to 15% per year and get somewhere to the 50. And again, whether the private credit portion of that will be somewhere around 5 or 10% of that as the asset class evolves. That's kind of how we think about the world.
And Jeannie?
It's on. Hello? Yeah. Yeah, I mean, if we're kind of arguing, oh my goodness. Hello?
No, that's our fault. That's our
Okay.
fault. We have to go off.
Okay. If we're arguing over the number, we're kind of at a 2.2 trillion number is kind of where we're thinking. And we think that grows at 10% per annum. Agree that the market is just very accessible, and kind of as we think about credit globally and holistically, maybe 25 to 30 trillion. And so just a lot of penetration, I think, that direct lending and the private credit market can do. We see new distribution channels through wealth management, ABS, et cetera. And really, I think the way this market's going to grow is because private credit has performed really well. It's been really resilient. And so you don't see growth unless you see performance first. And so I think we see that. And ultimately, also institutional capital, I think, has been saturated in corporates. And so we think private credit is going to have a chance to grow there. So do I think it's going to grow? Absolutely. Again, we're saying 10% per annum, but I'm pretty bullish that it'll grow at a rapid pace.
So Bobby, your world is, you touch many more kind of sub-asset classes, if you will. So asset base, I've seen 20, 30, $40 trillion. What's your view?
Yeah. So just have to give it a second. So we can start arguing about the size. We put it at $6 trillion today, on its way to $9 trillion. But I think the point that's most salient is what Jeannie mentioned, which is it's really accessible now, right? If you looked at this 5 or even 10 years ago, you could think asset-based finance is really interesting, but you couldn't necessarily invest $100, $200, $300 million tickets into it. I think what's really interesting is how much it's accelerated in terms of institutionalizing. Right, you have big firms right here who are able to manage capital into asset-based finance, and you're going to hear about now democratizing it, seeing it enter the private wealth channels. And this is all because these asset classes are growing in terms of knowledge of it. So I would say maybe 5 years ago, I could go to a corporate borrower, right, who wouldn't know that asset-based finance exists. But today, they seek us out, they seek Ares out. They want to borrow and access the asset-based finance market. And in a similar way, investors now, down to Main Street or the high net worth channels can access asset-based finance and be investors in that space as well.
Jeannie, let's talk about the markets that you touch. Your background is traditional energy lending, but EIG does so much more. Can you talk about some of the segments that you're involved with and where you see growth from each of those segments?
Yeah, sure. So EIG does energy broadly, as you mentioned. I'm traditional energy, and so maybe we start with traditional energy. I see a ton of momentum with traditional energy, and we'll probably touch on the banks and high yield market. But really, as the banks are retreating from traditional energy, the high yield market within the past few weeks, say post-Liberation Day, has been really closed off to anything energy. And so tons of momentum for private credit to step in and help fund development, fund acquisitions, et cetera. It's in general just a very capital intensive market. And so private credit will need to come in and fill that gap. As I think about the other subsectors and what EIG supports, maybe the opposite end of traditional energy, which is a mature industry right now, has that institutional kind of know-how, is energy transition, right? And so I think on energy transition, We're playing the long game, right? It's less mature. You've got to have that underwriting capability. You've got to kind of foresee the risks there, and it still needs a lot of capital as well. So private capital plays a role there. I put infrastructure debt somewhere in the middle. I mean, really, I think to put it in context, energy and infrastructure capital makes up 15% of the high yield market, and so that sector is represented pretty well there. And so on the infrastructure side, I think we see an area for LPs, or an area for more investing to kind of come in and diversify their accounts and their portfolios through the infrastructure debt lens. So I mean, we cover all aspects of energy, and I think there's a lot of momentum for the private credit, I would say, overall.
So Michael, let's have you address the impact from the volatility in public markets on your business, because we've heard in the last couple of weeks that spreads have gone out roughly 50 beeps in terms of the deals that were SOFR plus 500 are now plus 550. What sort of impact does the volatility, certainly in the last couple of weeks, have on your business?
Yeah, that's why I said busy, because we thought we were going to be busy because it was going to be the greatest economy ever, and that M&A was going to go through the roof, and that DPI was really important. Investors wanted their back, and the machine was going to be turned on. And we saw that in Q4, into Q1 on the M&A side, and then the administration started to put their plan in action, whatever that is. And I think everybody kind of took a big pause, obviously, with the volatility in the equity market. There hasn't been that much volatility in the credit market, so I think that's one kind of real difference in this market. Typically, like a 10% market in the equity markets would be a 30 to 40% market downward trend in the debt markets. It's kind of been more like 10 to 1. So you've seen a couple basis point trade-offs in the credit markets, but it still makes you get very introspective. And so I think firms that have been doing this for a long time on the private side tend to be calm and patient. You kind of get introspective. You have a playbook. You're like, okay, we have 300 portfolio companies in Europe. We have 500 portfolio companies in the US in direct lending. We have a big ABL book. We have doing that. And so we started to get introspective on our book with our Q3 marks, with our valuation marks, carried that in through the volatility over the past couple weeks, triaging companies that were most affected. We have 300 originators on the direct lending side. Those become 300 portfolio managers for a month because there's not a lot of stuff going on. You have pipeline deals. You're trying to honor your commitments. You are exploring widening them out to match what's going on in the public markets. Sometimes you have success, sometimes you don't, depending on who the client is and how good your relationship is. And now we're just kind of starting to turn the corner. I know this week's been really quiet in the market. I think people are trying to digest what a 90-day pause means. It's allowing us to kind of start to face the market again and say, hey, we have a lot of capital, we're open for business. I'm sure, obviously, there's like the alternative credit or the asset backside is where it tends to start first, because in particular last Tuesday and Wednesday, I think every bank was calling around saying, how do I generate liquidity? I have assets to sell. I need to sell a portfolio. Do you want to buy the residual? Do you want to lend against it? I need to generate cash. And so we started kind of last week and into this week, now going in forward facing the market, exploring on pricing and doing that type of stuff. So, again, tariffs, with any sort of volatility, I think the nice thing is, while private credit as an asset class has really matured over the last 5 years, we've been doing it for 27 years and operating with these books and kind of have a game plan for what we're doing. And yes, when we're looking at a company today, we're like, how effective would it be by this, that for new investments? But that's a culmination, of an investment committee that's been doing this through the financial crisis, through COVID, and so it's not. We don't ever look at things as just one point in time, but a culmination of everything we've learned from volatile markets and what could go wrong.
I was trying to make it until 12:30 before somebody mentioned tariffs, but the over/under didn't work in terms of how quickly we got there. So Avi, we'll come back to tariffs, but Avi, can you talk about volatility in public markets and how it impacts your market, certainly over the past few weeks?
I really want to talk about tariffs. No. So I think this is really important, right? People don't appreciate how powerful private credit is. And the reason why is because it takes advantage of a very elementary concept, which is liquidity, right? Most people, whether they realize it or not, especially institutions, probably have too much of it, right? The fact of the matter is that if you have an ability to hold on to things and you're not sort of forced to sell, you can and deserve to be paid for it. And the private credit market is really based off that. A lot of the things that we're doing are credit, right? They are in less liquid forms or less liquid markets, and there are premiums involved with that. So when you're looking at a volatile market like this, it's a feeding frenzy when you think about it, broadly speaking, for private credit. There may not be a ton of things to do now, but it sort of resets the market in terms of what's public and what's private. When public markets don't function properly, that increases the benefit of a private market. KKR, right, or any other large investment manager can do a unilateral deal and speak for an entire tranche, right? These are big firms, and that provides certainty and size and things that sometimes all of a sudden you can't necessarily get in public markets. So I would think the opportunity set increases for private credit investors, but I also think it's not the time to panic if you are in private credit, because if you are, that should in definition mean that you can bear some illiquidity and some volatility. And what you're going to see, more than in most markets right now, is that you can get paid for it.
Let's stay with you for a second, and let's kind of go into some of the subsectors that you touch, from credit cards to RV loans to real estate. I know it's music royalties, contracts, etc. As you think about the rest of 25, where do you see the most opportunity, and what areas are you perhaps staying away from?
Yeah, no, good question. So the first thing to take in mind, which is, as hard as it is for sometimes people to define private credit, it's even harder for them to define asset-based finance, right? Usually when I'm up here, the first question is, what is it? I will tell you that a very simple definition of it is non-corporate credit, right, broadly speaking. It's the thing that, most of you out there right now who have corporate credit jobs, you go to your children and you try to explain to what you do and they have no idea. But I can show them a car, a house, a credit card, they're streaming music, and they certainly know what it is I do, or at least they think they do. But what I would say even more specifically is, as hard as it is for people to sort of appreciate exactly what private credit is, I think what asset-based finance has really opened the eyes of folks has been what credit really is, right? I think at the end of the day, when you think of bonds and loans, you're thinking about corporate loans, but credit is actually much more than that. It's investing in promises to pay. And within asset-based finance, broadly speaking, that's exactly what it is. It could be pools of loans where you own obligations of people to pay, of small businesses to pay, of rents, of within aviation or being a home renter or anything along those lines. It's broadly speaking credit for the global economy. So getting to the actual question you asked me, which is where is the opportunity set, I'd say it's in fact pretty broad, which is a very sort of easy way to get out of that question, but it's very unique, as in, in 22 when interest rates were rising, there was a big opportunity in mortgages because rate volatility created a lot of problems for that industry. In 23 when banks were failing, Silicon Valley Bank and otherwise, the consumer opportunity was rife because banks were just selling high quality assets. They needed that capital very badly. But when in November, when Trump and the Republican administration was brought in, all of a sudden there was this euphoria. Like Mike said, everyone thought everything was going to be fantastic. And to a certain extent now, everything has sort of fallen into this world of volatility and uncertainty. But broadly speaking, what we're seeing is the opportunity set doesn't necessarily exist in a particular area versus another. It exists in a particular borrower versus another borrower. And what we're finding is in times like these, where there is uncertainty and also a lot of risk of tariffs again, so inflation, it creates a recessive tax across people, across companies. And what we've done is we've leaned into larger and higher quality creditors. To the point that I was making before, the variance between doing something to a high credit borrower versus a medium or low credit borrower, you're not being paid enough. to take that additional risk when you think about the backdrop of the economy right now. So our general posture has been try to find folks that are high FICO, have a lot of disposable income, find companies that have many sort of channels to access credit and liquidity, and you're going to have a better bet than you would trying to go after the small and marginal borrower.
Let's expand on one of the points you just made, and that is, I'm curious if you've seen any consumer stress yet in the past couple months, and if so, where?
Subprime, right? We have a $70 billion portfolio, so we have a lot of our own data. But to be honest with you, any of you can go onto the Fed's website and you can look at the data that's out there. The fact of the matter is that non-prime is performing worse than prime. Now, take it with a grain of salt, and no one needs to panic or jump from any windows, because the truth of the matter is that there's been a lot of savings coming out of COVID. So if you look at disposable income figures relative to GDP, if you look at savings relative to earnings, you're going to see some really positive global sort of ratios there, that people are not over-levered, people are not sort of really getting squeezed. But when you dig into that and you bifurcate that data between who's performing better and who's performing worse, you see the folks that are really struggling are the non-prime young people, right, who haven't really established themselves from a credit or from an income perspective, and people that live in some geographically difficult areas. And this could be MSA driven, in terms of where their employment is. Again, sometimes it can be very regional, but I will say there is a bifurcation there between the haves and the have-nots.
Okay, so Michael, same theme. Where are you seeing stress in any particular sectors? Again, haves and have-nots. Or anything that's concerning you year to date or the last couple of weeks?
Yeah, I think similar to what happened during, when rates were going up and inflation was happening, what you thought was a fairly recession-resistant industry like healthcare got hit with kind of a double whammy. So if you were in a levered healthcare services business, that company, if it had leverage on it, was seeing both their interest rate go up by 500 basis points, but then really the catalyst for stress was labor going up by 40%. And so you kind of isolate industries in and around that. For today, obviously, the service economy is doing better than the industrial economy. You're seeing holes in energy and things like that. So kind of your typical suspects, really. I don't think there's anything novel about what's gone on there. The consumer's a big worry of ours too. You haven't seen it probably in any of the numbers that we have yet if you're working off of February numbers and March flash numbers. We haven't seen real consumer stress. But if you go deep into kind of the subprime and some of that data, and you look at a lot of the flash consumer sentiment polls and things like that, you're definitely seeing a shade there. So we are looking at anything interfacing with the consumer as potentially being there, and then obviously not to use the T word, but anything that is sourcing globally. Products or other things are things on our watch list. Like I said, when you go into that introspective mode, I always, people are like, you must do that, and half of your portfolio must go on your watch list and whatever it is, and it's just not the reality. We have 1% of our loans are kind of on a non-accrual or default or in some sort of workout, very, very small number. And those are just ones that we're working on, and like maybe the watch list is 3%, and maybe that doubles or goes to 10% of the names that go on a watch list. But it actually is a fairly small number of kind of what's going on, and it's very, more so than not, it's company specific, and or some myriad 2 or 3 different global factors are affecting it. Because most companies could have, if it was just rates going up, most companies that were 2.5 times interest coverage went to 1 3/4, and it was fine. It actually kind of worked. It was really something else that probably put it on the watch list, and that's what we're trying to do right now, is kind of what are the ancillary causes and effects of things that are going on into the portfolio.
Let's expand on the tariff comment. What do you share with your portfolio companies about how to handle this, right? Because it seems like each day is a guessing game. We're one tweet away from some new direction, but what do you share with portfolio companies who are struggling with order patterns?
Yeah, so I mean, first we were just kind of saying, what, how's it going to affect your revenue and your profitability to do that? We have to kind of, as part of looking at, if now a company has 90-day reprieve, are they going to draw the revolver and try to bring in as much product as they can? And as one CEO says, our strategy is stack it high and let it fly. Not a great inventory management system, but is that what they're going to do over the next 90 days? Get as much product in so you can, after 90 days, be like, shut it off. I don't want to get the tariffs. Or is that being too preemptive? So we're kind of like, we're sitting in the background saying we are open for business, but communicate with us. If you want to go draw your revolver and bring in as much inventory, if you need a loan to go do that, we're open. It's more expensive today than it was, but we'll work with you. And so again, we're trying to be that liquidity provider, that partner-oriented capital that doesn't come through banks. So if the banks are looking for liquidity, they're not lending credit. We have a much more calm, much more kind of measured response where we are saying we are absolutely open for business, we're your partner, and we can price that risk for you. And so that's really our message to them. And then obviously in that 3 to 5%, we're diving in, right? We're like, hey, listen, all of your product comes from here. How are we going to do this together? We're probably going and visiting them and really trying to get our arms around it.
Jeannie, oil has not been immune to the market volatility. So how does that impact your markets, whether traditional energy or transition or infrastructure? And what sort of stress are you seeing in any of your subsectors?
Yeah, and I'm just listening. I think we need a bingo card here: liquidity, volatility, tariffs. I think look, I like volatility. It's good. We force a lot of hedging in our term sheets. We have downside mitigants. We have covenants that bring the companies to the table. To me, volatility really means opportunity. And so, really liquidity is king right now. And as I think about oil and gas companies, I think about the energy sector. It is so capital intensive. Maybe just to put it in perspective, because I'm not a generalist, and so these other industries, I think just, a typical EV company that's $2 billion might spend $500 million a year reinvesting. And so it is a treadmill for these oil and gas companies to be putting capital to work. When there's volatility in the market, and that means the high yield is shut off and they can't access capital that way, it really brings people back to private credit, and it really brings us to the table to negotiate with these companies. The risks are, it's a commodity business, right? And so obviously hedging is very, very important to us. Whenever we do a new investment, that's a must. A recessionary environment could slow down development. Like I said, it's a treadmill, and these companies, oil, gas, really any of these energy companies, they have to be reinvesting, and they need a constant growth or at least stability within kind of what their production is going to look like. So that's a risk. As I think about tariffs, obviously there's a lot of tangible items that are being imported, and so steel at 25% tariffs affects the industry. You'll be maybe surprised that on an overall well cost, that's only a 2% increase. And so it maybe doesn't impact them as much as one might think, but battery storage coming in, if it's not locally sourced, tariffs are a risk. And then maybe I would add that, while I like volatility, the market dislocation can cause banks to step out in a way that we don't always want. If banks aren't there to support M&A or to support growth, then the deal doesn't happen, right? And so private credit is obviously a solution that I like to push with our companies, but we have to have the bank support as well. And so market dislocation for a long time can actually be hurtful to the industry.
So that's a good segue to banks. And so I want to get this quote right, so please allow me to read from our friend Jamie Dimon. Because the banks over the past 9 months, some of them anyway, 10 or a dozen or so, have decided to get involved in private credit. But I'm going to read to you a quote, or a couple quotes from Jamie Dimon last May. Quote, "There could be hell to pay if private credit markets wobble." He warned that there are bad actors in the industry, and they'll likely be the source of any issues. But he did say, "I don't think it's systemic, but I do expect there to be problems." So that was May. February 24th, JP Morgan announces a $50 billion balance sheet commitment to private credit, along with an additional $15 billion from partners. So the question is, have you started to see, Michael, have you started to see any impact from banks offering, I mean, look, let's face it, the banks have phenomenal sourcing, right? Because they've got the end client. They have no underwriting. Have you seen any impact from banks yet?
No, really no. And it's been, the evolution of the banks has been kind of the evolution of the private credit markets. Very much, going back 25 years, they were, we all worked there and every bank kind of partnered up to finance the middle market. Then the post-financial crisis kind of seeded the middle market. Both from a regulatory perspective, just the capital they had to push against those assets, but also from a people perspective, meaning the banks aren't staffed to go find middle market loans speaking on the corporate side, and do that. And they started kind of to be, instead of competing against us, kind of coming in and lending to our portfolios. So again, what Jeannie was saying, like, it is part of the vibrant market, and they are very much in the private credit market as lenders against our portfolios or to our public companies. And so they kind of did that, but they were still kind of the enemies that seeded the market, and then they were kind of frenemies where they would compete against us when a company got to a certain side, but definitely a friend of ours and lending partner on the backside. And I think we just kind of keep moving towards partnership. I really do. Because of liquidity and because of regulation and because of staffing and goals and kind of how they're organized. I think most people in this have heard it, that they are in the distribution business and we're in the storage business. So they're in the moving business, we're in the storing business. And I just think that more and more as, the larger alternative asset firms and people that are in this business get larger, have more capabilities, can do more things for their clients, the banks will then we are becoming big clients of the banks to do that. Again, the orientation and the way they think, so we know how that $50 billion program works, and there's already now pushback from the private equity community saying, you're now trading that we don't want you to trade. The whole point is not to trade it and not to court it and do that. And so I actually think there's going to be pushback against them doing that type of stuff from the private equity community. It's going to draw them away from that because that's just their mentality and kind of the fee orientation that they drive themselves to. So I know it's an internal battle for them that's been going on, and this is kind of like a new hybrid model here. But we continue to see them becoming more and more constructive as a partner of ours and less so as a competitor.
And Avi, how about your world? What have you seen over the past 9 months in terms of banks kind of getting more involved in your world?
Yeah, it's very much the same answer as Michael, which is, it's a big market and banks are an important player in that market in certain ways, right? In terms of how they lend, in terms of how they conduct flows, because as you pointed out, they do have relationships. But in terms of what we do on a direct basis, like we're never going to be really competing with the bank. I think everyone sort of saw what happened in 23, with the mortgages when interest rates went up, and Silicon Valley Bank and Signature Bank and others who, with rate volatility, or if there's other type of volatility in the market, like private credit, the holders, be it pension funds, insurance companies, sovereign wealth, can hold through volatility. A bank, is not necessarily built the same way in terms of how they're regulated, in terms of how their deposits fund them. So it's not necessarily waking up one day and thinking that banks are going to necessarily compete with us directly. Jamie Dimon, I started at JP Morgan. Jamie Dimon was sort of like the first CEO of the company. I remember he used to go down to the front of the road and basically all the black cars, he'd send them home, right? So he'd make me walk home. instead of being able to take a car. But he's not making me walk home today, right? Like, there's no way a bank is gonna come in and start doing the types of things that, you know, the investment managers are doing because our capital is so different.
Let's hit two more topics before we go to Q&A. And the first topic is going to be M&A. And so, Michael, let's start with you. A lot of folks, myself included, thought we'd see an uptick in M&A this year, and for the most part, it really hasn't happened. What are you seeing?
I think there'll still be a fairly healthy M&A market. It's kind of what, in buyout land, at least where we focus, it's on our direct lending business. It's kind of what makes the world go around, and we're actually seeing a bunch of high-quality businesses trade hands. There's a lot of private equity dry powder. There's a lot of people raising new funds that need to get return capital back to investors. So if you're looking across your portfolio companies, you might say, I'm gonna hold on to my biggest grower, winner, do that, but if I have 10 companies, I'm gonna sell 2, 3, and 4 that are probably high quality, high multiple, ability to get leverage and do that. So I think that there'll still be a healthy market. You know, again, there'll probably be more recession resistant, but, you know, in that software, healthcare, pretty localized, obviously, in the service side of the business. So I'm not totally down on the M&A environment. And we are still seeing transactions get done. And again, there's even the banks are kind of still fairly proactive on what's in their books, and kind of, you know, the idea of like the hung deal right now is actually on the bank balance sheet is, you know, 1/3 of what it was during COVID, and they're saying deals are still going to happen. We're going to move this paper and go do it. So I'm actually fairly constructive on the market. It's kind of, you know, it's not what I think we expected, but I think that it'll still be a fairly robust market.
Jeannie, M&A impact on your sectors?
Yeah, I mean, I think in 2023, energy had the biggest M&A year. It was at 120 billion with Exxon and Chevron's announcements. And so the industry's very much consolidated over the past couple years. I agree with what you said, Michael, a ton of private equity, you know, which helps new funds, will help source that M&A. They're gonna need private credit to come alongside. You know, when I think about kind of M&A, I think that what's the most consolidated sector is like the auto industry, right? You know, it's like there's like 4 to 5 big names. And so when I think about energy, I mean, there's like 40 to 50 companies I think about right off the bat in the US. There's a long ways to go on M&A. A lot of consolidation that can happen. And I think, again, as these big companies have done the consolidation, they're gonna start fragmenting again, and they're going to need new teams to be sourced to come in and kind of fund those. So yeah, very positive on it.
So Avi, we normally talk about M&A in the corporate sense, but is there any M&A that would be impacting your subsectors?
Certainly, you know, any industry that, you know, touches our space would also be a candidate for M&A, and there's certainly companies we're looking at right now. I think if you spoke to us right now in November of 24, we'd be hooping and hollering, right, thinking that this M&A market would be massive. I sit 2 floors away from our private equity brethren, and I'm sure I would have heard them screaming, you know, for joy with, you know, we were in that type of environment right now. But, you know, obviously there's more volatility, right, so people need to pick their spots. I think it's kind of why private credit has sort of become sexy, you know, in the matter of there being more volatility, you know, there being some constrictions to growth, public markets being less reliable. Those are all, you know, ingredients which make public markets and M&A markets sometimes a little harder to access, but, you know, it does make borrowing more costly. That's wonderful for us. It does make public markets function less, you know, efficiently. That's wonderful for us. So, you know, I think on the margin, you're going to see a bit more private credit opportunities versus public equity opportunities. But, you know, I agree with both Michael and Jeannie. Like, you can't keep a good man down. There's too much dry powder. There's too much of a need that's been held back. Those markets are going to be accessed. It might not be the multiples they were hoping for, but that doesn't mean they're not going to use those markets and use us for credit.
Yeah, and we saw a bunch of public to private ideas presented to us last week. So markets dictate kind of what type of M&A is going on, but you know, in these types of markets and volatility, you see a lot of corporate carve-outs, you see public to private, so it might come in different shapes and forms, but the market will dictate a little bit of that. And I would say there's a lot of private equity capital going in and saying, again, going back to liquidity, you know, can I provide a corporate liquidity with a carve-out, or buying some of the brands, or buying some of this business out of there and doing that. So it comes in different shapes.
So a year ago, not just in the States, but in Europe, there seemed to be voices that were calling for more regulation about private credit in general. And so the question quickly for each of the three of you is, where do you think we go from a regulatory standpoint? Are there any new changes coming that would impact your markets? It would seem like the answer is no, but I'd like to ask. So Avi, why don't you start with that, if you would?
Thanks for that.
I was hoping my microphone wouldn't work. So look, I think regulation's a good thing, right? Like it definitely keeps out bad actors. It definitely makes a functioning a market more effective. But you know, I think a lot of the calls for regulation were coming from banks. We're not going to regulate ourselves like banks regulate themselves around credit. Like that's silly, right? Like, we don't have the same sort of controls and sort of subsidies and sort of, you know, needs in terms of, you know, we're not systemically important to the economy in the way a bank would be. So it just doesn't make sense, and it's not efficient to conduct a market to that level of regulation. If you're talking about disclosure, if you're talking about, you know, auditing and things like that, such to ensure that things operate appropriately, great. If you're going to start talking about sort of capital regulations and sort of regulatory bodies, I think that's a little bit of an overstep, and I think, you know, the lobbying efforts and most people in my industry would sort of agree with that.
Jeannie?
Yeah, I mean, maybe briefly, maybe more broad. On the European side, you know, we see kind of LTAF or LTIF 2.0 kind of bringing in new forms of real estate money or different kinds of dollars into the private equity market, and that can help fund LNG, can help fund kind of some of these big infrastructure processes, and so maybe that's a blueprint for the U.S. I think in the U.S. the last administration had kind of talked about bringing in 401ks into the private credit, so just different avenues. When I think about regulation from that aspect, I think smarter regulation is not a bad thing. I think it's broader participation is not a bad thing. But you know, again, you know, when in November, when the new administration, specific to energy, when the new administration was coming on, I think in the energy sector, we all thought, okay, this is a good thing, less regulation. Now I think there's a lot of volatility and uncertainty on what that's going to mean for energy specifically, and so you know, it's just we're bracing ourselves for what could come.
There is a fair amount of regulation that's already going on. I think that there's probably some way we can move forward on transparency and not regulation. I think that's the big thing, especially as you talked about, or we talked about earlier, which is just as these asset classes become more democratized and get into the hands of different people, maybe through 401ks, but definitely through the retail channel and things like that. There needs to be, you know, more standardized transparency about what you're doing. I think some of our brethren and Aries are trying to lead the way in a way that makes sense, that's digestible and means something, not just transparent to be transparent.
It's a good word, transparency. Sometimes people will mention to me, like, it's so hard to find information on private credit portfolios. And I respond with, we're just not looking in the right place or talking to the right people. Information's there. All right, let's, last topic, and that is, what investing or life lesson, and we'll start with Jeannie, would you offer our audience before we go to Q&A?
Well, I'm still seeking out life lessons, but if I had to kind of give 3 investing lessons that have maybe stayed with me, one would be always learn something from a bad investment. There's always something to be learned, and don't waste it. 2 would be, don't trust blindly, whether that's your management team, whether that's your deal team, etc. I think the motives are not always aligned, right? So do your own work and stay sharp would be my 3rd one.
Avi?
Yeah, you prepared us for this one. So, and I had one that I've sort of stood with me for my whole life. So when I first graduate from college, I took a job with JP Morgan, and this was sort of in the early 2000 era. I got a signing bonus, right? Like I'm a professional athlete, I got a signing bonus. So I took my signing bonus, it was like the first money I ever had, and I stuck it in the NASDAQ, right? Because this internet boom was really taking shape, or at least so I thought. And I got my face ripped off, right? It's my first experience, and like the more I think about it, like JP Morgan should have been watching what I did with them. I should have been fired right there. Right? It's like, let's see how these people invest their money, and like, no, he's not for us. So the lessons learned are like, thank God for that. But you know, one, you should definitely know what you're investing in, obviously, and two, you know, wisdom of the crowds might not necessarily be wisdom, right? Just going with the flow and sort of doing momentum trades without really understanding the consequences in it, or it's obviously something we should all be mindful of. And thirdly, for me, was stay the hell out of equities.
You know, it's funny, my first job in 1995 out of undergrad was on the retail side of Fidelity, and a lot of the traders I sat with were complaining about the firm's trading restrictions on your personal account. And then a few months later, you'd hear people talking, you know, by the water cooler, like, wow, thank God compliance stopped me from doing that. Right? Michael?
Yeah, I have to say, I have a similar type story. I worked at Solomon Brothers in the FIG group, and you know, we had the stub year when you start in August, but then my first full year, you know, I thought I crushed it, and I went in and got my bonus, and it was the smallest thing I'd ever. So I called my dad, and I'm like, I'm quitting, I'm gonna go in, I'm gonna tell this guy. And he said to me, he goes, go home and sleep on it, and you'll play the conversation out in your head 100 times, and then when you go, but I still want you to go in there, and I want you to go in the next morning, and you'll be way more articulate, you won't be a hothead, and trust me, it'll be a much better situation. And so that is the temperament that he taught me, and that's a little bit like, that's kind of been my life lesson, is like, you know, right now is like the same thing, like you kind of want to go like, you know, am I hitting a bottom? Should I get in now? Should I do this? And like you have all this noise, and you're playing game theory, and you know, some of it's, you know, it's all this noise, and kind of push it into the background and digest as much as you can and do that. But then, you know, do the fundamental work, play the long game, be patient, you know, be mindful, be thoughtful, be articulate, all that type of stuff. And it's kind of been a good life lesson for how we invest in. And it's part of really what's attracted me to the private markets versus being a trader or being, you know, in public equities and things like that.
All right, we're gonna go to Q&A. Someone texted me a question while we're up here, but I'm not going to ask it. The question was, why are private credit people so awesome? Just kidding.
That was my other word. My other word was going to be awesome.
All right, Q&A, any topic. All right, in the back.
Thanks, Scott. Greg Magnus in Newburgh, Berman. I chatted a little bit with Avi beforehand, but I'll include you as well. I'm curious, out of that 30 trillion opportunity set, how much of that is outside of developed markets like the US and Europe? And to the extent that, you know, there are some green shoots in private credit in emerging markets, how involved are you, and what do you see as obstacles, challenges to growth there?
Well, I don't know the exact number outside of the developed markets, so I'm not going to speak to that. But I will say on the challenges that we face within energy, I mean, gosh, there's so many in those markets. So we look at West Africa a lot. We look at some of these emerging markets, and it's stability, it's policy, regulation. I mean, back to regulation. And so I was having a conversation this morning over breakfast about offshore Africa versus onshore. You don't want to be onshore in energy, you know, and so it's just they're different risk sets, or different risks that we look at, and so you have to really know the underlying hard assets, which is great. That's what private credit can kind of lend against, is hard assets and energy. But you know, it's tough when you don't have boots on the ground. You don't know the market as well. You look at Argentina versus kind of its neighboring countries. It's a totally different risk profile. And so having terms that are rock solid, that bring companies to the table, having hedging, downside mitigants, and more, et cetera, is just paramount to those types of investments. Again, don't know the split exactly, but developed versus undeveloped markets for private credit are going to cost more. They're going to come at a premium, which is positive, but there's a trade-off for that. And so having a team that understands the technical risks, I think, is incredibly important to those jurisdictions.
Yep. Yeah, the legal system's probably the only one that you left out is kind of
Yeah.
how do you move on your collateral and do things like that. We're trying to scope it. We just did a big acquisition in Asia, Japan, and we're kind of tackling it from Hong Kong, Sydney, and Mumbai, and that's and we're focusing on right now the developed parts of those the developed countries there. And on a corporate basis, even India is a little bit hard right now, and you also had then the other hard part is capital formation around it. So you can get one investor that's like, I love everything, give it to me, and then the next investor for that same fund is like, I want to do X China, X emerging, and so it's kind of hard to form the capital because all your LPs have different views on where they want to be, and you can't really do fund to ones, and so the capital formation is really hard around that. So we have a couple really good young kids at the office, and we're kind of like, that's for you guys, that you're 25, 30-year-olds that are in the office. We're like, Peter, Bob, Kathy, Jen, this is for you because we're not going to be able to do it, but in 30 years, when you guys are running the place, that you'll be doing that. So we're staying developed for the most part because that's where we can form big pools of capital, and the legal system and the sourcing system and our ability to act on the collateral is solid.
Just add on the legal system, we have kind of a inside joke, as I agree, the legal system is a huge risk. If you're, maybe this is not appropriate to say, but if you're not in a developed country, those docs are like, they're written in a bar napkin versus, we're a pretty litigious country here. There are tight docs here, and so just big risks.
Yeah, I don't have a ton to add to that, only that within the world of asset-based finance, like the fact that it's institutionalized now, the things that you really need is like a really institutionalized, sophisticated credit market, as well as one that's not completely dominated by banks. And I think what you'll see in a number of those markets, in the end, they don't necessarily tick those boxes. So while there's probably a ton of private credit being done there, in the form that that's investable, not as much.
Yeah, Joe Dominguez with AllianceBernstein. Thank you all. Primarily for Jeannie, but with regards to energy transition, energy storage, and the new administration, how are you handicapping any potential changes in tax treatment, and how does that affect your investment going forward?
Yeah, again, not the best person to ask on tax, but I will say what we're thinking about on energy transition is, like, if there's a softening demand for oil and gas, that'll affect merchant power pricing and on kind of that side on energy transition. It's going to affect not just the recessionary, but tax and policy, all of those kind of policy things that were in place, like the IRS, everything, right, that supported some of that underwriting. And so, the underwriting is so important, and you can't bake that in to energy transition. It's a long game right there. There's a lot of risks. It's also capital intensive. On the tax treatments, I would say we haven't really leaned in on that as a collateral to the investment. And so it's a benefit if we get there, but it's not paramount to our underwriting. And look, we spent a lot of time trying to underwrite carbon capture, storage, et cetera, and we just couldn't get there on the credit side, honestly. And it's because we're not underwriting all of those benefits. So energy transition has a long ways to go. It needs capital. It's primarily equity right now, and I think on the credit side, we're looking at it. It's going to take a lot longer to get to that amount of scale and quantum that it needs.
Shockingly, I have something to add. So we do a bunch in renewable energy, in terms of solar, but be it residential or utility scale. And those markets are driven by the subsidies that exist. So we pay careful attention to how the tax code changes. More on the forward, no one's that worried about grandfather tax benefits that come in, but it will change the landscape. You know, as an example, there has been discussion about the IRA being repealed, although it's been murmurs in the House. And that would sort of impact the difference between sort of lease systems versus loan systems. And you're already seeing companies begin to do the calculations in their mind as to what ifs and how that would adjust the market. And it would be pretty meaningful. But these are just another example of uncertainties that exist in our market right now that people just can't necessarily operate under because they don't know what the steady state is going to be.
Hi, this is Melody. Thank you so much for your time. I'm with Credigy. I primarily focus on consumer credit, asset-backed investing. So I know we touched upon like subprime consumers are getting stressed right now. What do you think for the near prime as well as prime consumer credit in the space in the upcoming years? I guess like was the rate presumably higher for longer as well as the tariff? What's your baseline view, optimist view, as well as a recession view, and how does that compare to the 2008 financial crisis on the consumer credit side? Thank you.
I'll let you go.
As it applies to energy? No?
No.
You guys got this one.
Well, first of all, a lot of respect for Credigy, owned by National Bank of Canada and a very sophisticated investor in your own right, so I won't pretend to know everything that you guys do. Thank you for coming. But I guess what I'd say high level is nobody knows, right? The issue less has to do with what we expect versus what the volatility of outcomes are. And when you're dealing with near prime and subprime, probably near prime more than any other segment, there's a lot of volatility, right? People call them, like, used to be subprimes, right? The fact of the matter is that post-COVID, I was speaking about the quality of consumers. A lot of people still have a lot of liquidity from stimulus, right? So you will see the average FICO of all of us, right? Congratulations, has risen roughly 20-ish, low 20-ish points from before COVID. The average FICO score in the US used to be in the 680 area, but now it's low 700. So if you have a low 700 FICO score, you're just average, I'm sorry. But at the end of the day, like, that's actually really meaningful because from a credit pricing perspective, the difference between prime and subprime pricing is very meaningful, right? There are sort of definitions of prime versus subprime, which dictate pricing and the like. So I think what you're going to see is policy is going to matter right now. A lot of the economy is being driven by fiscal and policy making, less from monetary policy, and you're going to see that those things really dictate how those consumers perform, right? It's not going to be an easy environment for the Fed to act, right? You have a slowing economy and you have high rates. What's the Fed supposed to do? Well, they can be hawkish or dovish, but in either case, in an economy like that, it's very hard, to sort of protect those people.
Thank you.
Anybody else? Last call?
Hi, I'm Leanne Schmidt from Star Mountain Capital. We're a U.S. lower middle market private credit and credit secondaries firm. Last year, the secondaries market, I think, has hit an all-time high. Curious about your perspective. That includes, ABL, infrastructure, credit, growth certainly is the dominant. Private credit, I think, only makes around 3 to 4% of that. What have you seen, observed, and do you anticipate, just given the potential for a denominator effect, investors seeking liquidity, what do you see in terms of that area and opportunity going forward?
I can take that one. I think it's probably one of the underfunded categories out there, and like our secondaries teams across everything, private equity, real estate, infrastructure, and now credit, have an insatiable amount, a desire for capital and a lot of good uses for it. I think that the whole market is evolving, so like secondaries is kind of the buzzword for it, but you've obviously seen we run out of our asset-backed lending NAV loans or solutions around private equity firms that are trying to either reinvest in their companies or reinvest in their next funds and things like that. So there's this whole suite of products that are coming that could either be considered alternative credit, it could be really direct lending, a preferred against a bunch of pools of assets or things like that, or a pure secondaries, either GP or LP led. So I think it's an emerging part of the market to, again, address these liquidity questions that we're having for a different customer, which would be your LPs and your GPs. and kind of what's going on. So I think that market is going to continue to grow and evolve. I think that if you looked at the volumes from last year, the capital raised is only like 2 times that. So it only has 2 years of runway. So I think you're going to see a lot of formation coming in the upcoming years to get that to a more normalized market of something like 4, 5, 6, 7 years, something like that.
Anyone else? Last call. Michael Smith, Jeannie Powers, Avi Korn, thank you very much. Much appreciated. Thank you.